China's future trading power rests on three words: market economy status. At the end of 2016, certain rules governing how countries treat China in trade cases are set to expire. That's when China believes its trading partners must acknowledge it as a market economy. But not all countries agree with China's interpretation. The question of whether to treat China as a market economy has sparked a contentious debate, one that could have drastic and long-lasting effects on Western industries, from shrimp to paper to furniture and, of course, metals. So to better understand all this, let's go back to 2001. That's when China joined the World Trade Organization. As the WTO considered China for membership, some member countries worried that Chinese companies would unfairly compete with their own domestic industries. That's because at the time, China's Communist Party had extreme influence over the costs of production and prices for Chinese products. But the WTO system is meant to promote competition and non-discrimination in global trade. So if the WTO failed to address this disparity, China would have more easily dumped products into the US and other importing nations. So, China agreed to special conditions when it joined the WTO. These conditions specified which costs and prices could be used as benchmarks when countries were conducting anti-dumping investigations. This is called price comparability. It gets pretty technical, but basically, if the investigating nation can prove the country or industry being examined does not operate under market principles, it doesn't have to accept the prices and costs that China uses. Instead, the importer can compare prices from similar nations. The current method treats China as a non-market economy, and this typically helps affected industries support their dumping claims. These conditions fall under Section 15 of what's called China's Protocol of Accession to the WTO, and they're set to expire on December 11, 2016. Based on the language of the agreement, China believes this expiration will automatically reclassify it from a reforming economy to a market economy. What exactly is a market economy? It depends on who you ask. At the most basic level, a market economy is one where the costs of production and prices are set by supply and demand. That's the opposite of a planned economy, where a central government sets everything: costs, prices, wages, output quotas, and more. But here's where things get tricky. Giving a country market economy status is not an academic decision. It's a political one. Individual countries set their own criteria for granting this status. For the US, it comes down to 6 factors. The first two consider currency and wages. Currencies in a market economy are typically convertible to those of other countries. Workers' wages are determined by free bargaining between labor and management. The next 3 factors revolve around inflows and outflows. Officials must consider the extent to which joint ventures or other foreign investments are permitted, and how much the government controls the means of production, allocation of resources, and the price and output decisions of enterprises. The final factor leaves room for any additional criteria that could be deemed appropriate. It all falls on the U.S. International Trade Administration, under the Department of Commerce, to evaluate these 6 factors. And there are several groups with a stake in that decision. Steel associations, think tanks, and law firms have all come out in force against granting market economy status to China. They say it would cost the U.S. hundreds of thousands of jobs and destabilize entire industries. Defenders of China's interpretation say that U.S. companies and consumers would ultimately benefit from China's lower-cost goods and services. As this year's presidential race has shown, America's trade relationship with China is a hot-button issue. Populist voters have come down on NAFTA and the Trans-Pacific Partnership. Many say China has already been unfairly dumping products for years, and market economy status could make it worse. Ultimately, what the U.S. government decides by December 11th will be a defining milestone for the future of global trade.